good evening to our viewers from VC World, which is the venture capital community of BW Business World. We have with us today Mr. Vikram Gupta, who is the founder and managing partner of a $530 million homegrown venture capital fund, IvyCap Ventures. He has more than 25 years of experience in private equity, business consulting, mergers and acquisition, strategy and operations across an extensive range of industries. He has held leadership positions across various well-known companies in India and abroad. The firm invests through its alumni ecosystem and has currently nearly 35 companies in its portfolio. Mr. Vikram Gupta has conceptualized and established India's first endowment fund at IIT Delhi, which was launched by the Honorable President of India in the year of 2019. Mr. Gupta is also the co-chairman of the Private Equity and Venture Capital Division of the Associated Chambers of Commerce and Industry of India and is an active member of the Indian Venture Capital Association as well as the Confederation of the Indian Industry. Thank you so much for joining us today, Mr. Gupta.
Thanks, Anisha, for having me.
I'll be starting with our first question. So IvyCap was started around in the year of 2011. So could you possibly tell us what led to the inception of IvyCap, and were you focusing on any specific sectors in your initial years of investment?
So, Anisha, just even before IvyCap was started, the idea was conceptualized at the time when I was raising a fund for a very large, corporate in India, where I was raising $100 million fund focused on the healthcare and life sciences sector in India. So this, I'm talking about the year 2008-9. Markets were really bad, and this was after the crash that I actually succeeded in raising $100 million in the domestic market. Dollar used to be 40 and raised 400 crores from 30 plus Indian institutions and a large number of individuals in the country. I started investing from that fund 2009 to 2010, and as the luck would have it, Purplle decided to sell their healthcare business to Abbott, which was one of the largest deals of its time, about 3.72 billion. Part of it was non-compete. And the reason why that fund was actually had to be treated differently. So it gave me the opportunity to move on to set up IvyCap Ventures in 2011. So it was the March of 2011 when started IvyCap from scratch. The whole idea started with the experience of interacting with the alumni of various IITs when I was raising the Purplle fund. Every time I met an IIT alumnus, irrespective of which IIT they were from, the connect was instant. And that's where the thought process started. Why didn't we have a platform with the IIT alumni coming together through one platform and supporting the startup ecosystem? So that worked very well. And, in fact, I discussed this idea with my co-founders now, Ashish, Vishal, and Anju, who were also same batch, same hostel. They really loved the idea, given the fact that we decided that we would give back a substantial part of our profits of the fund managers back to the alma maters of the investors. That connected very well with the alumni of all the IITs and the IIMs. The whole thought process also led to the foundation of India's first endowment fund at IIT Delhi. So it took us almost about 8 years from the date of conceiving this idea to actually setting up the IIT Delhi Endowment Fund in 2019, which was launched by the Honorable President at Rashtrapati Bhavan. And in the process, we raised our first fund between 2012-13 and deployed it between 13 and 15, which was deployed in 10 companies at that time, mostly in tech across consumer, fintech, B2B SaaS, healthcare. So we invested across different companies. And once we deployed Fund 1, we raised a second fund, which was a 530 crore size fund. And that again we deployed in 23 companies, and most of it came from our investors from Fund One, and a few new investors were also added. And we recently started raising our Fund Three, which is targeted to be 1,000 crore plus 1,000 crore target. We were able to do a first close at 1,608 crores in March of this year, and finally we are very close to announcing a final close, which would be a little over 2,000 crores. So all put together, given the value that we have created, we are already at assets under management of close to $530 million, as you mentioned. We've already given returns to our investors in Fund One. On one side, we have the IIT alumni as our investors. On the other side, we have the Indian institutions. We have over 25 Indian institutions who are investors in our fund. In that sense, we are today the largest homegrown VC fund in India. We are also the only fund in India which is actually which has more than 25 Indian institutions. In fact, most of the other VC funds probably will not have more than two Indian institutions as their investors. We are the only VC fund in the country which is also supported by the IIT Alumni Trust, not just in India but globally. And we are the only VC fund so far, or maybe the first VC fund in India, which has actually created a dragon in the portfolio. A dragon is a company which gives you more than 1x return of the entire fund. So we created India's first dragon last year when we made an exit in Purplle, where 15 crore investment yielded 330 crores in a 240 crore size fund. And of course, there are many other firsts in terms of we're the only VC fund globally which is actually giving back as endowments back to the educational ecosystem. And in India, we are the champions of creating the endowment ecosystem. So in that sense, we're quite proud of what we created so far, and we're quite excited about the future.
So you've had more than 25 years of experience in this industry, and as an investor also, you've had the fund for over a decade now. So how would you say that when you're investing when you're shortlisting an investee, how do you identify an idea that would change an industry? And what is it that you're looking at in the founding team when you're making your investment decision?
So we use both top down and bottoms up approach, Anisha. From a top down perspective, we look at sectors, the macro picture of each sector, and we look at empty spaces within that. We look at the broader trends in the industries. We look at what spaces have been already captured, which kind of companies are getting funded, etc. And therefore, we identify specific areas that may have potential for investments. So that's a top-down approach that we use. Then there's a bottoms-up approach where we actually keep building a very strong pipeline of portfolio companies or target companies through various measures. We have an IvyCap platform which does very active engagement with startups. Currently, there are over 3,000 curated startups on that platform. Plus, of course, we have large mentor pool. Through our mentors, platform, we get a lot of referrals on the companies, and of course, we get deals through our own networks, through our advisory board network, through the team network. We are a team of 35 people, and direct deals come to us also through various bankers, etc. So, in that sense, we have access to almost every company in the country. Given that, we keep looking at a bottoms-up approach where we look at the teams, the founding teams, we look at the business models, we look at the execution ability in specific business models. We look at within the business models, we look at what are the key models around profitability, around scale, around capital efficiency of the business, around the founding team structure in terms of their cap tables, the motivations that the team have, what are the other solutions available out there. So there's a very thorough due diligence, and we actually spend almost about minimum about a year to 2 years before we finally take a call to invest in a particular team. So we track these companies over a long period of time, and then finally invest in them. We typically take substantial minority stakes. Our sweet spot lies somewhere in the range of 25 to 30%. We are a Series A investor. We are sector agnostic. technically, but when we go after companies, out to the market, we are looking to invest in consumer tech, fintech, health tech, B2B SaaS companies, and various other disruptive models. And typically a ticket size about 40 crores on an average, but ranging from 15 crores to 50 crores. So that's the ticket size we're looking for, and we then reserve substantial capital for follow-on investments as well, to make sure that we retain our stakes in these companies and then help them scale up. We also deploy our mentor model in every company that we invest in. Our mentors come through our ecosystem of the entire alumni of the IIMs and the IITs. And typically, every time we do a Series A investment, 1% of the cap table at the time of entry goes to the mentor trust, and another 1% goes to the specific mentors who get assigned to the company. And therefore, we believe in very active support to these companies. As I said, we don't invest without a board seat, or we don't invest without a mentor support. And we very actively take interest in supporting these companies and giving them access to customers, our entire ecosystem of the IITM alumni ecosystem, and various other support things that we do, whether it is supporting their technology development and other things. So that's how we look at investing.
As I just mentioned, that IvyCap is currently a $530 million fund, homegrown fund in India. And the fund is also very close to closing its third round at this point. So does IvyCap go abide by any specific fund deployment strategy? Could you talk to us a little bit on that?
So, generally our investment strategy is very consistent across funds. Even with the 240 crores in our first fund, we didn't want to follow a spray and pray model, right? With many of our peers may have followed, right? So at the time when we started, there were about another 5, 6 funds that started at the same time in the year 2011, 12. And almost every other fund was following this approach of just put 1 crore to 2 crore ticket size in companies, creating a portfolio of about 100 companies or 100 plus companies. We stayed away from that approach. Our approach was very clear that we will only invest in very handful of companies, and we will take very active stakes in these companies and very active roles in these companies. Being the first institutional check in these companies. For example, Purplle, for a 15 crore investment in 2015, we took a 30% stake and were very active in the company. And the company was just doing about 60, 70 lakh rupees a month of revenues. And at the time when we sold our fund one stake last year, they were almost about 50 crores per month of revenues. And now they've crossed 100 crores of monthly revenues, right? So the company is really growing, month on month. And the same thing with Clovia. When we invested in them, 15 crores in 2015, 15 crores for a 30% stake in the company, took a board position. So you will see a very consistent pattern across our portfolio companies. We'll be looking for substantial stakes in these companies. We'll be taking very active board position. We'll be bringing our mentors very actively to support these companies. So that's a very consistent approach that we follow across our funds. Except that we've assigned one small fund with our IvyCamp platform that we've created, around the time we conceptualized. And that platform has a seed fund along with it, where we put 1 to 2 crore ticket size as well. But that's basically to make sure that at very early stages we support these companies, and they also become target for our Series A investments for our larger funds. So that's a small pocket that we've created to make sure that we capture some of these companies early on. So we might also create a small pocket in a fund 3 to make these seed stage investments. So, but otherwise our strategy remains the same, and it's very consistent across our funds.
Any specific exit strategy that the firm has been abiding by? I'm aware that the company has already made several very successful exits from tech companies from India. So any specific exit strategy that the company has been implementing over the past few years?
So interestingly, and we are told that we are probably the top performer in the country today from domestic funds perspective in terms of the actual cash return to the investors. In a fund one on a 240 crore size fund, we've already returned in cash 2.2x net of expenses, net of carry, net of everything back to the investors. Somebody who invested 10 crores in the fund would have already received 22 crores in cash back. And this is just selling half of the portfolio out of the 10 companies, right? Even Fund 2, we finished our deployment last year with the, a 530 crore fund deployed. And by now, we've already returned 35% of the principal back to the investors. So, which means that somebody put in 10 crores in the fund, they've already received 3.5 crores back in cash. And this is primarily driven by the fact that, we are very, very proactive in thinking of the exit strategy right from the time we make the investment. And, just to give you a broader picture of how we think of exits, we think of a pecking order like this. First objective is to actually see whether this company will reach a scale where it will become attractive to be bought over by somebody else. So an M&A is actually a first priority to exit. Six companies that we've made profitable exits from, five of them we have actually done M&A. We actually sold the companies to other companies. For example, Clovia we sold to Reliance recently. August we sold to a national stock exchange. Socrati we sold to Dentsu of Japan, and so on and so forth. So we've been actually selling these companies. Only in case of Purplle, we did a secondary exit to Sequoia and World Invest. And typically, a secondary exit, people have a perception that is done at a discount to the round. But in our case, it was actually done at a premium to the round. So we got a very good exit, in that case. The first priority is M&A. The second priority is can we take the company to an IPO, or is this an IPOable candidate? Because typically, given that we are Series A investor, the time frame that we have available is not necessarily aligned with taking the company to an IPO level. But that is always a scenario in case of a fund one, for example. One of our companies, Bluestone, is actually already getting ready for IPO as we speak, while we were very early stage investor in the company. So that's an option that we evaluate as an exit option. The third option is obviously the secondary sale. So we actually look for selling our stake to another investor or another shareholder in the company. And these are top three priorities that we look for in terms of exit, and we start planning it even before we actually make the investment to see how we will exit. And there's a time frame that we define for ourselves. Typically 5 years on an average is our time frame to exit. And so far, touchwood, we've been very successful in our exits.
Of course, we know that post the pandemic, there has been an acceleration in the way venture capital funds are being invested in startup companies. And a lot of that is as a result of the increase of tech solution that got integrated into MSMEs, integrated into various stages of and industries activities. So could you tell us a little bit about how do you look at the tech industry moving forward in India in the years to come?
So, one has to think of it from a macro scenario, right? I mean, India is actually really booming right now. And we know that India is, when it comes to startup ecosystem, over the last 2, 3 years, India has moved even better than China. If you look at the overall scale of startups across the world, I think there are roughly about 1,100 global unicorns today. Of course, the largest number of unicorns are sitting in the US. The second largest sitting in China right now. The third largest is in India, right? So we've already crossed 102 unicorns in India already, and the largest number of unicorns were created last year. About 44 unicorns were created just in the last year. And given the size of investments happening, talking about $63 billion of investments that happened last year. And I think this year, again, while there has been a little bit of slowdown from the expectation, which was there in the first 6 months, we are actually continuing to see the pace in terms of the company scaling up, despite the fact that the liquidity has gone down as compared to the last year. Uh, India at macro level is expected to grow at 7.5% at the in terms of the overall GDP growth. But if you look at the overall number of startups, there are about 70,000 registered startups as per the DPIIT data. In our assessment, about 25,000 of those startups have actually got seed or angel funded. Only about 1,200 to 1,500 have got Series A funding so far. And that translates to about 102 unicorns. So that's how the pyramid stacks up. And in terms of the tech opportunity, obviously, India is very uniquely positioned with the size of the population, with the consumer market sitting there, with the age of the population. Less than 30 years of age is more than 800 million people in this country, a very young population, and majority of the people less than the age of 30 and more than 15 are on their mobile phones. So therefore, they become very attractive candidates when it comes to any e-commerce or digital businesses. We've seen a revolution happening in the last 2 years after COVID, when a substantial part of companies or substantial part of businesses actually moved from offline to online. We've actually seen it even in our own portfolio. For example, Bluestone, which is actually a jewelry company. One would not have expected someone to go buy, a 5 lakh rupee jewelry or a 10 lakh rupee jewelry online. Unless you actually have this touch and feel, people really didn't want to buy such expensive items. Now we are seeing that trend completely shifting because people are getting that confidence and the comfort with online buying. And that's all bodes very well for India because as you see more internet penetration, as you see more smartphone penetration, we are talking about the number of internet users in India and the smartphone users in India touching close to 800 million. I think those numbers are mind boggling. And for VCs like us, I think that's a huge opportunity to take unicorns, the startups to unicorn status over the next few years. In fact, my personal prediction is that India should see 500 new unicorns over the next 8 to 10 years. And IvyCap per se is actually quite uniquely positioned to help build some of those.
So, what is the next roadmap for IvyCap? Of course, we know that it has already invested in several successful tech-based companies in India, made several successful exists. What do you have in mind for the growth of for the further growth of IvyCap in the next few years to come?
So, we want to be the first and the largest global fund out of India. And so far, our focus has been primarily in India. But we believe, given the opportunity that lies ahead of us, building a business of global scale out of India, we probably are very uniquely positioned from that perspective, given the fact that the alumni of IITs are spread across globally. We know that the largest alumni base of IIT sitting in Bay Area, followed by Bangalore, followed by Delhi. And then, of course, there are alumni distributed across other geographies like Middle East, Japan, Southeast Asia. So we believe that we can leverage that kind of ecosystem and therefore create a fund of global scale. We are looking at building a minimum of another $1 billion kind of potential within the next 2 to 3 years itself, and become, a part of the top few funds, in the next 10 to 15 years globally from venture capital perspective. So we're quite excited. We're quite hopeful that given the way things are going, we should get there in that time frame.
I'll be asking my final question. Being guided by an entrepreneur centric investment approach, what is your message for entrepreneurs who are looking out to raise funds this year?
So, of course, there are a few things. One is a generic, irrespective of the market situation today, I think generic advice, whether the market is good or bad. And the other is very specific advice, which is because of the current market situation, how they should look at it, right? From a generic advice perspective, many entrepreneurs sometimes just end up raising funds from the first investor that they meet, and they do not negotiate very well. So at times they would just see the money, and they would think of the valuation they were looking for, and they get that valuation, and they believe that they got where they wanted to be, and they end up raising money, and later on realize that there were certain things that they should have done at that time and they didn't do. So choosing your investor partner is very important. Therefore, do as much due diligence as an investor would do on you in terms of looking for the right investor partner, because now the number of investors available in the market is very large, whether they're angel investors or later stage investors, even though investors at Series A, Series B is still very less in this country. But at angel stage, you'll find plenty of investors. So you make sure that you choose your right investor partner. That's one. Second is make sure that you raise enough money that you really need rather than just what is available. Many times entrepreneurs make this mistake that they believe that larger amount of funds are available, so let's raise a larger amount. But I think as long as you've done your planning enough and make sure that you raised for the growth as well as for cushion that you need to maintain when you're raising your next round, I think you should be fine. So size your fundraise accordingly rather than based on what the investor is looking to invest or what kind of money is available out there. And the third is, I think, more than money, and this is related to the point number one, choosing the right investor partner, is in terms of looking for the right advice upfront, in terms of getting the right mentors upfront, getting the right support system, reaching out to the right set of people to get advice, and also making sure when you form your teams, have the right incentive structure and motivation structure, because eventually it's about having a very good team that is aligned towards achieving goals, and because eventually it boils down to capital efficient execution, which makes the huge difference. Now, this is specific. This is more generic, rather, in terms of irrespective of the market situation. But given the current market situation, I think certain things which are very specific to the current market situation. One is that you need to make sure that you have enough capital with you to survive for the next 12 to 18 months at least, or even 24 months, because the amount of funding out there in the market is not as much as what you saw in the last year. Therefore, make sure that you're not burning money, and therefore conserving cash, and that should be basic attitude anyways. But in today's market, it becomes even more important. And the other thing is that in today's market, again, there will be interesting trends which will be emerging. One of that is one can expect some consolidation happening. And if you are able to survive this market, I think you will emerge as one of the maybe top few companies in your space. So it all depends on how well you are able to sail through this market situation. But look for the right partners again, even in this market. And while valuation is important, I think focus more on getting the right color of money, so right investor partners. So these are some of the important suggestions, and I think make sure that focus is very important in your business. Many times, entrepreneurs end up making a mistake thinking that if my idea doesn't work, uh, then I should have a backup, and that backup sometimes gets very visible and actually takes away your focus from your core business. So my other advice is to make sure that entrepreneurs should stay focused on the problem they're trying to solve, because sooner or later they'll be able to figure out what's the right solution. Then they'll be able to scale up very well. So these are some of the suggestions for entrepreneurs in today's time.
Thank you so much, Mr. Gupta, for joining us from BW Business World today. And this video will be viewed by various investors and various entrepreneurs. So I'm sure your responses would be extremely insightful for them to make their further decisions, whether the investors are making their investments or entrepreneurs are seeking for investors. So thank you so much for joining us today, and we look forward to having you with us again.
Thank you, Anisha. Thanks. I really enjoyed this discussion. Thank you.